Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another fine week. I've got with me in the studio today, Melissa R. Curry, the head of marketing for Bullington Capital. Welcome to the show, Melissa.
Thanks for having me on.
Oh, thanks for coming. We're going to be talking about a lot of stuff today, and I always like to start off by promoting the upcoming seminar that we have. And that one's going to be on October 6th. That's a Thursday night. You can go to my website to find out more about it. But I'm going to tell you a little bit about it anyway. And
what are we going to be talking about?
Oh, well, it's actually two parts. The first part's going to start at 6:30. And we're going to talk about individual stocks. I've had a lot of requests because I used to talk a lot more about that on the show. I just haven't had a lot of time lately. So I'm going to do a stock talk. In there, I'll have the ebook done. By the way, we did send the preliminary ebook out to all the people that came to the seminar last time on the dividend model that we run. So this time, the model that, or the little ebook that we'll have ready to go is basically how to pick stocks. And it's kind of a back of the envelope type of program. It doesn't take a lot of energy, and in fact, it'll do about 90% of the work that you actually need to do to evaluate a company. And where it really helps is somebody mentions something, you can go home and look it up on Yahoo Finance or Google Finance, and you can do some back of the envelope calculations, and you can tell how attractive or unattractive a stock is based on its economic value. So, sounds a lot more complicated than it is, especially when you say big words like economic, Normally it's only 2 or 3 syllable words, that's it. And so people call in all the time, the radio station, they ask, what about this stock? And so I decided to write all this stuff down. Incidentally, I got most of this from the National Association I can't even speak. National Association of Investment Clubs. Back when I was in college and I was taking a finance class, one of my finance professors said, "Yeah, you might want to subscribe to this," and he explained it. So I went ahead and sent my $35 in, which was a lot of money in the mid-1980s,
Sure.
especially for a kid who didn't have a lot of money.
Yeah.
And it was very helpful. But after doing a lot of that, and then when I got into the business, we had to do these big, long spreadsheets. We didn't have to, but if you wanted to know anything, you had to work through the material. And I found out that there were a lot of shortcuts that would get you about 85% of the way that filling out the spreadsheet would. If you did a really, really detailed analysis, in 15% of the instances, you might find something that you wouldn't find using the simplified version.
Huh, interesting.
So me being kind of lazy, oh, and by the way, when you do the 85% of the analysis on 85% of the companies, you will find out which ones are attractive. You just won't know exactly how attractive they could be based on the 15% of the information that you won't be looking at. Huh. Occasionally that 15% is significant. I can tell you most of the time it is not. So the vast majority of the time, all you need are these back of the envelope calculations, and you can get an idea for how risky or how safe something might actually be in just a couple of minutes looking at financial statements. And that's why I thought I would do this, because I've been asked about it a lot. I put some material out over the years, prior websites I had, and it was really fun. A lot of people got it too, and but I had to take those down. So I'm going to go put this up, and eventually it'll turn into an ebook, and everybody can do it. And beyond this stuff, beyond looking at the back of the envelope calculation, you're going to get into things that are incredibly complicated. Okay? This is going to be good for about 85% of stocks that you come across. That other 15%, the reason that you're going to have to work a lot harder on those is because the companies are significantly more complicated. That's kind of a key. Like if you were to look at, I don't know, Berkshire Hathaway, it's owned by Warren Buffett. You look at all the moving parts in that company. Now, he owns something like 80 companies. I can't remember exactly what it is. And then he has a common stock portfolio that's in the billions. So that is really complicated.
Oh, sure.
And I would say you probably want to stay away from that. Or you wait until the 85% rule, 85% of the information that's actually going to have a major impact on it until it's grossly in favor of you buying that stock at a undervalued price. You'll know what that is without having to do that other 15% of the work. It's amazing. Like in economics, they used to teach diminishing returns.
Oh, yeah.
Or diminishing marginal utility. That's how they like to say, you're not getting as much benefit.
Sure.
Kind of like how the IRS says 71. It's 6 months after you turn 70 and a half.
Yeah.
We were just talking about that. Yep. So anyway, that's going to be October 6th. That part of the seminar is going to start at 6:30. We'll go for about 45 minutes, take a 15-minute break. Come back at 7:30, and we're going to talk about momentum. Momentum used to be a bad word in the investment arena. It's really kind of funny how that's evolved over the years. But people used to, they really hated it. And I know why they hated it, because it's volatile. It was much more volatile than a lot of other investing methods. But, if you could put up with the volatility, the returns were generally worth it. So we're going to be taking a look at that too, because I use both momentum and value-oriented strategies in the strategies we use at Bullington Capital. So I thought I would take some time and explain in detail some of those things that we're doing there.
That sounds like a fun seminar.
I hope so. It's a lot of work if it's not. But and I wanted to bring Melissa in because one of the things in the future that we'll be focusing on more is really women and investing. I've been reading a little bit, and I talk to a lot of women. In fact, there's a huge majority of the wealth in this country that's actually owned by women because they generally, in the old days, a lot of women would marry men that were older than them fairly significantly. And then when their husbands passed away, they end up inheriting, all that net worth. So there is a very large percentage of net worth. And now today you've got women that are CEOs of Fortune 500 companies. You've got a woman that might be president. So things have changed, but the feelings in the financial services industry, I guess, from what I'm reading, has been very slow to change. They're hesitant. And I'm not sure why that is. So I thought I would bring someone on and get a woman's point of view from a lot of these things, and which explains why you're here.
Oh, thanks. Well, yeah, like you said, things have come a long way for sure. But, before this, it's been mainly a male-dominated industry. So I think that's maybe one of the reasons why women are a little intimidated or maybe fearful or just don't know what questions to ask. Just looking for more information and basically, looking for somebody that has their best interest in mind.
Right. I'll tell you from my personal experience, women are better investors than men are. And maybe that's sexist. You're going to have to call me sexist. They are better investors than men are. And I can tell you why. The same reason men don't like to stop and ask for directions.
Yeah, sure.
You see,
I could see that, yeah.
Type A personality is okay as long as it's under control, especially when it comes to investing. So, and you've got a lot of experience in Eastern philosophies, I think, which would be very helpful for a lot of women.
It's fun to read about, yeah.
Being calm.
It helps.
What's the word that you use? I keep
equanimity. So just keeping, a balanced mind, trying to be, peaceful in the moment. I know easier said than done, but there are a lot of emotions involved with, investing in the stock market, and it's a lot to take in, especially if you're just beginning. So, just keeping that balanced mind, looking at everything from, kind of an open, relaxed mind, I guess. and just
Right.
keeping that balance there.
Well, you've been you've progressed tremendously.
Oh, thanks.
Since you started with us, and it's
I feel like I have. Thanks.
Yeah, no, absolutely. And I wouldn't have any doubt that no matter what happens, you'll be successful.
Oh,
And
thanks.
I think it'd be really helpful for other women to kind of get a feel for it. They tend to be more practical. At least that's been my experience.
I'd agree with that.
Now, I don't know about your generation because you're so much younger than I am that I haven't spent a lot of time with people in that age bracket. Older women tend to be much more thoughtful. In when I'm saying older, I'm saying past the age of 65. Okay, so not that I consider that old, but it's older than I am, older than you are. Then they grew up in a different era. And the vast majority of them did most of the shopping for the house. If they needed a vacuum cleaner, they were the ones that were going to buy it.
Yeah.
If they needed to get a new dishwasher, they did the research and they picked it out. They bought a lot of the groceries. They basically ran the household. Many of them worked outside of that, by the way, worked outside the home because actually being a homemaker is a lot of work.
It is. It's a full-time job and then some.
Especially when you have kids.
Oh my gosh.
So they were more in touch with the quality of the products.
Sure.
Because they were using those products a lot of the time. And they were very practical about it. And they were used to budgeting. So I think there's a big misconception there. I'm not sure how it got started or where it got started. Actually, I think it's a bunch of type A males that started. So I thought it would be very interesting to have a woman's point of view and to try to incorporate that into shows and whatnot. Everybody needs to know. And in fact, a lot of women still to this day, I guess, I don't know, but from what I've been reading, they still rely on their spouses or significant others to do a lot of that stuff for them. And they have some pretty basic questions, which I think need to get answered. Because first of all, the answers are not that difficult, and secondly, it's information that you really should have. It's easier to compare products that you're going to buy that you can handle, that you can touch, tangible items, than it is to compare stocks or mutual funds, because those are all on paper.
Sure.
They're entries on somebody's checkbook or their personal financial balance sheet. So it's not as easy to evaluate from a standpoint of doing the math, looking at the numbers, unless you've been trained for that. And getting training for it is, I don't even know where it exists. Other than the National Association Investment Club, they stopped doing that sheet quite a while ago, and it really kind of upset me. It's one of the reasons I want to write the ebook, because there are really a couple of things that, as an investor, that you need to know. And like I said, I've had more success over the years dealing with female investors than male in most cases. Now there are some males out there that are well-rounded and very thoughtful. I can tell you they're few and far between, and it just seems to be more common with female. And I think it goes back to the practicality thing. They just have to be practical.
Yeah, it's a big part of it.
Yeah,
Absolutely.
And for some reason, many of them seem to be more patient. I'm not sure why that is, but anyway, maybe it's just the ones that I attract. I don't know. They come to my seminars, or call into the office. So, did you have anything you wanted to add to that at all? Not really?
Can't think of anything right now. No.
I did. We were talking about this a little bit earlier, and one of the comments you had was that before you got here, a lot of the explanations that you got were overly complicated.
Oh yeah, for sure. Just, big words you couldn't really understand, and concepts that were pretty simple, because I know they're simple because you've simplified them for me. You've shown me that. And, I really enjoy your videos. I enjoy your blogs. I enjoy our morning meetings and the seminars. I've learned an awful lot, but you keep it simple. You simplify these overcomplicated, or they shouldn't be overcomplicated, but
right.
they make it they make it a little bit complicated, and you dumb it down. You know, yeah, you do a very good job. So it's a lot easier to grasp and understand.
Yeah, I appreciate that, and I have to tell you, one of the things that I picked up from you, meditation, just being calm, breathing. Mm-hmm. Yeah, breathing is a big one.
You can't survive without that.
That's really helped. I mean, it's amazing how just being quiet and focusing on your breathing, not even breathing a certain way, letting your breathing happen and observing how that breath goes.
I love it.
Clears your mind.
Yep.
I think that helps a lot. Your yoga experience also, I think, helps a lot.
Oh yeah.
Helps
with every aspect of life. You know.
So that's something else. Maybe we'll have to do a workshop one of these days on yoga and investing.
Oh, that'd be fun. We should do that.
Yeah. The things that you do before you look at your financial statements.
That'd be a lot of fun. Yeah.
Yeah.
Do some breathing, meditation, some stretches. That'd be fun.
Right. Yeah, that would be fun. Anyway, because in the meditation part, when you're getting involved in this, I think there is a tendency to get upset because stocks are volatile. Mm-hmm. We were just looking at I was showing you a worksheet here that somebody sent to me, one of the big mutual fund company. And it was talking about how over the last 50 calendar years, from 1966 to 2015, the highest closing price of the S&P 500, the distance from the highest closing price to the lowest closing price during a year averaged 28%.
Wow.
That was the average.
Wow.
And that's 1 year.
Jeez.
Now you put 2 years back to back that are bad years, that's how you get the minus 50% over a 2-year time period. But the average 1 year, and I thought that's very important for people to know, because I'm pretty sure the vast majority of the public, male and female, are not aware that the ranges are that large.
I had no idea.
Yeah.
Nope. Wow.
And this is where meditation would really help.
Yes, breathe.
Especially when you're at the bottom of that 29% range. That would really help a lot.
Yeah.
And just understanding that that's actually how the market works, and that's natural. That's normal for the market to have very large price movements.
Absolutely.
And somebody that's telling you any different than that. And by the way, there are lots of products out there today that will promise you stock market-like returns without the volatility. Now that I hear the music, we'll have to wait until this commercial break is over to tell you what the real deal is on that story. Anyway, you're listening to Bill Bullington and Melissa Arcuri right here on 1420. Stay tuned, because we'll be right back.
Let's go. He walks further down the street with the brim pulled way down low. Ain't no sound but the sound of his feet. Machine guns ready to go. Are you ready? Hey, are you ready?
I know you wanna leave me, but I refuse to let you go. If I have to beg, plead for your sympathy, I don't mind, 'cause you mean that much to me. Ain't you proud of that?
And we're back. Well, I can relate to that song. Okay. So we were talking about how there's some products out there that are promising stock market-like returns with little or no risk. And I have to tell you, there was a point in time where you could actually do that and you could achieve that. You could get stock market-like returns with minimal risk.
Really?
Yep. That day is gone. The products that were doing that are still being sold today, but what's happened is the insurance costs have gone up so much. The premiums for those types of products have gone up so much that it's eaten away at the returns, to the extent that the returns are going to be incredibly low.
Wow. Okay.
And so really the only other option that most people have today is to get a fairly large portion of your assets put into some good solid stock strategies, whether they're funds, exchange traded funds, basket of stocks like we do at Folio. That's what you're left with, because interest rates are extremely low, probably likely to stay that way for an extremely long time period. As I said, I've got this sheet. There's basically $14 trillion worth of publicly held debt out of the $19 trillion worth of debt. 14 trillion of it is held by the public. Actually, 2 or 3 trillion of it's held by China. But anyway, so if they raise interest rates 1%, that's 140 billion extra dollars
Wow.
in interest payments.
Wow.
That is nearly half of the military budget.
Sheesh.
Think about that. So that's just a 1% increase in interest rates. That's why it's not likely that interest rates are going to go up a lot. You know, they made a big deal about Janet Yellen raising interest rates. And by the way, Janet Yellen, another woman in control.
Yeah.
You know, she runs the banking system, which, by the way, runs the world. It really does. The Federal Reserve of our country affects every other country in the world. But and it's run by a woman, and quite frankly, she's doing a phenomenal job.
It's a big deal. Yep.
And in fact, when I see her testify, you know, she gets grilled by Congress and Senate all the time. She handles that better than anybody I think I've ever seen. And I think it's she does it so well it makes me laugh. But anyway, so she understands $140 billion a year extra. She knows that if you're spending $140 billion a year just on interest expenses, that money's going to have to come out of the other budgets from the United States government. And at some point in time, they're going to have to fix the bridges.
Right.
Just kidding. But so anyway, I just thought that was an interesting thought. Interest rates probably not going to go up anytime real soon. That's been hurting a lot of insurance companies who invest in bonds and used to expect that, you know, as a return on their investment as part of their overall income was the interest that they would get. So it's hurt their profit margins. I forgot where I was even going with this whole thing. Oh, yeah, the interest rates are probably not going to go up anytime real soon. So your alternatives, really, you've got. You could go out and start a business, which I know everybody wants to do when they retire. You can go back to work full-time in a business and work harder than you did as an employee of another firm. Or if you're already owning your own business, you know, you can keep running your business. If you got $10 million, I guess you could buy 1% pretty easily. You know, that would be $100,000. So $10 million at 1%, you get $100,000. By the way, you have to pay income tax on the $100,000, so you're probably going to be left over with $80,000. And I don't know anybody personally that has $10,000 in treasuries. I'm sorry, $10 million in treasuries. I'm sure they're out there. They're just not my clients. And but I'm also pretty sure that they're probably not living on $80,000 a year if they've accumulated $10 million bucks. Right. So I really don't see any other alternative. And these hedged programs, they're not the cost of hedging, if the long-term average of the stock market is somewhere between 9 and 10%, and the cost of hedging is higher than that, how do you make money?
Right.
Now, having said that, there is a way, even though the total cost is because the returns are uneven. You'll get a big return. A hedged portfolio will capture a portion of that, okay, for that particular month. And so you can have a positive return. It's just not going to be very high.
Gotcha.
And without losing everybody that's listening right now, I don't want to go into the explanation of how that works. But basically, because the market does fluctuate a lot in a month, when you're using those hedges, when it goes down, oftentimes you can make money on the hedge when it goes down. So the smart guys are doing that. And it just offsets the losses on the months where it doesn't go up or it's flat and you've had to pay for the insurance costs that's come out of your the pool of money that you're managing. Long story short, you can't make much money at all without putting up with that 29% average range of the S&P 500.
Sure.
28%. 28% is the average range per year. You get 2 bad years in a row. That's how 2007 through 2009, that was actually about 18 months, and it was over a 50% drop. So without putting up with that, okay, you're not going to make a lot of money. And the key, kind of what you and I were talking about a little bit earlier, you're talking about equanimity, is trying to decide how much of a decline you can take. And I think you said, you were talking about the risk, the right amount for you. That's very important, and very encouraging for me to hear those words coming out of your mouth, because I didn't put them there. And if you go back and you read on our website what I'd written several years ago, you probably didn't know that I'd written something very similar to that, because that is the key.
Yeah, absolutely. Everybody's different. There is no cookie cutter process for each person, and we're all different, and there's a right around risk for each person, and it's going to be different for everybody, you know?
It is. And I'll tell you the types of portfolios that I would suggest to someone really is based on the interview that we have in the answers to questions that I'm going to ask really dictates. I'm trying to customize and get somebody more comfortable with the types of investments that suit their personalities.
Absolutely. Yeah.
And I'll show them all, and I let them pick too. And when they ask for a recommendation, I'll tell them why I'm recommending. But ultimately, it is their money, and they just need to know what they're up against.
Exactly. Yeah.
And we try to do a good job of bringing that to light. Okay.
I think you do a great job. You do a really good job of that, explaining it and making sure everybody fully understands and making the best decision for them.
Yeah, but you're biased now.
No, I've heard you. I've sat in meetings, and you do a very good job of being, very clear.
Well, thanks. I really appreciate that. And and again, going back to one of the reasons I knew you'd probably be good in this position was that I saw you work under stress and under pressure, and how you're handling it. It's not easy when you've got a whole group of people that you're instructing, and your music goes out.
Hey, anything can happen.
When the technology breaks.
Just breathe, go with the flow, hang in there.
I've
this
been
too
there.
shall pass.
Yeah, absolutely. And a large part of it is just, it's really so much common sense. If somebody breaks it down for you, there are a lot of 4 and 5 syllable words, generally accepted accounting principles. They're 8,000 pages. Internal Revenue Code, 8,000 pages. It's like they got together and said, "Hey, let's make our things 8,000 pages." Just kidding. But it can be very confusing. So we're going to try to help people out. Coming up October 6th again is the workshop. At some point in time, maybe we'll do a yoga and investing workshop. It would really help.
Yeah, I'm curious if people would be interested in that. Yeah.
Yeah, it would. I'll tell you, before I scan, I started stopping just for a couple minutes. I just close my eyes and breathe.
Yeah.
And I breathe deeply because I like to. It makes me feel better.
It does.
But and then it's calm and my mind's open a little bit more, and I can run through my scans more quickly. And I'm not as apt to miss something when I'm calm.
That's awesome.
So yeah,
That's
works
great.
out.
Just a little breathing, what it can do, right? Change your whole world.
Oh, yeah, absolutely. So anyway, yeah, we'll have to work on that for the future. But I'll remind them again. Go to the website bullingtoncapital.com. October 6th. It's a 2 parts. You can come for one or both. It doesn't really matter. 6:30 we'll be talking about that back of the envelope calculation to be able to tell somebody whether or not you'd be interested in a stock. And back when I first started in this business, most people got their information from their stockbroker. The information to acquire it was expensive. The Value Line used to cost $500 a year. That was a $500 subscription back when $500 would be about the equivalent of $2,000 in today's dollars.
Yeah.
Just for this big book of 1,500 stocks that you still had to look through manually,
That's a lot of work. Yeah.
page by page. And then you had the S&P 500 that covered more stocks than that, but it was outrageously expensive. I forgot what it was, like $1,200 or something for a paper version of it.
Sheesh.
And there were no computer systems to be able to go and sift through the data like that. You had to do it by hand. In the Wall Street Journal actually used to print these little tiny segments of every company that ever reported their earnings. Well, not everybody, like the top 1,000,
Okay.
the Russell 1000 stocks. When they would report their sales and earnings, they had these little tiny, looked like coupons actually, and they were spread out through the paper. And that was one of the ways for them to get you to go through the entire paper,
Smart.
because you'd have to look through. Yeah. And so I remember this guy, it was a hedge fund manager, the guy was really successful too. And one of his methods for tracking these companies was to go through the journal every day and write down on an index card the sales and margins for the companies. And he had it was a little back of the envelope calculation. And this guy ran hundreds of millions of dollars this way very successfully. I thought it was pretty funny. Now, today, you can do it with computers. You still need to know what that stuff means.
Sure.
And you still need to know which pieces of data are extremely significant and which pieces of data are not so significant.
Yeah.
And that's really not that hard to do. I hear so many people, and in fact, people that call into the radio show quite often will ask about something and it's not significant. And I feel bad because when I tell them that, they think I'm being a bad guy.
No.
It's the old kill the messenger routine. Hey, what do you think about blah, 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 blah? Well, I don't know. I look at their total sales and I look at the sales that particular division has, and it's less than 1% of their total sales. Well, not so much. Well, what do you mean? So it's kind of interesting. You don't want to be one of the what do you mean guys. You want to be able to know that so you won't have to call in and ask anybody. You can figure this out on your own.
Yeah.
And I used to call it the 60-second test, by the way. I did it the old-fashioned way. And the Look Out for the Bull book, it's really very similar to that. That one's slightly more drawn out. I think the whole book is 32 pages, and one of the pages gets repeated 9 times, and I double-spaced.
Well, that page is important.
Yeah, I double-spaced the text. So there's less than 5,000 words there, and those are the most important things.
Sure.
And I guess rewriting that is what we're really doing for this, to put out another little ebook to try to make it even simpler than that. It really shouldn't take much more than 1,500 to 2,000 words.
I like that. Yeah.
That's the 85% that I was talking about earlier in the show. 85% of what you need to know, you can find out in a few minutes.
Yeah, that's great.
And that other 15%, you can do like I do and give it up. I'm not going to try to find those companies.
Yeah.
I want the ones that are going to fall into that 85% number where it's all you need. When you get to that other 15%, it's a what is the old baseball slang that it's a long run for a short slide.
Oh, okay.
So that really complicated stuff, sometimes it can help. But even then, there are ways of simplifying even the really complicated stuff. And then you get to an area where things are just so complicated that you just want to stay away from it because there are too many things that could happen that you can't possibly forecast for. And when you recognize that, now you're really on your way to being probably a really good stock picker. And not that you ever want to pick stocks, but if you pull up a mutual fund and you see what the top holdings of that fund are, and you see that 3 out of the top 10 stocks are hopelessly overpriced, what that's going to tell you is that portfolio manager got lucky. He bought stocks that went up that shouldn't have gone up as much as they did. Why did they do it? Because people got overly optimistic about it, and he just happened to catch it.
I bet that happens a lot.
It does until it doesn't.
Right.
And those portfolio managers end up dropping out. And Standard & Poor's does a constant annual review on how many funds in the top 25% stay in the top 25%. And the number is abhorrently low.
I bet. Oh my.
I can tell you and it's for exactly what we just talked about. Portfolio manager got lucky. got lucky. How do you know he got lucky? Well, you wouldn't know that unless you knew this back of the envelope calculation.
Yep.
And you could apply it to the top 10 stocks in that mutual fund. If you did that, you would realize that, hey, this guy just got lucky.
Yeah.
Some funds, you'll find out that, hey, no, this is not lucky. They're paying attention.
Mm-hmm.
They're not overpaying for these companies, and the companies are doing well.
Mm-hmm.
That fund has a much higher chance of repeating its success, of staying in the top 25% than the ones that just got lucky.
Right.
And, I hear the music. That means we got to take another commercial break. You're listening to Bill Bullington and Melissa Arcuri, both with Bullington Capital Management, right here on 1420 The Answer. We'll be back after these messages.
I bet you wondered how I knew I'll show plans to make me blue with some other
And welcome back. You're listening to the Bullington Capital Report, broadcast every Saturday morning from 11 to noon on 1420 and 6 o'clock on our sister station 1220 a.m. I'm Bill Bullington. I've got with me in the studio today Melissa Arcuri. And thanks for coming in today.
Oh, yeah. Thanks for having me.
Well, yeah, appreciate the having somebody to talk to here on the radio show. I hate talking to myself for an hour straight.
It's fun.
Anyway, I promised that I would talk a little bit about Medicare on the last show.
Mm-hmm.
So I think I'll just mention a little bit of that right now. When I'm looking at this, you've got 3 months before you turn 65 when you should sign up for that.
Okay.
That's a key. I think that the most important aspect of this is not missing your enrollment period.
So 3 months before.
Yep. 3 months before you turn 65, you want to start the process. Now, if you work for a company that has more than 20 employees
Mm-hmm.
and their health insurance extends and covers people that are on Medicare,
Mm-hmm.
then you need to call somebody there, call us to talk about you actually have an extended or special enrollment period.
Okay.
And your plan may end up turning into what they call a Medigap insurance policy.
Mm-hmm.
But that you need to start looking at that before the
Really?
deadline.
Yeah, for sure. Don't want to miss that one.
No, because it's talk about crazy. You get into an automobile accident and you get injured. You could be looking at tens of thousands, if not hundreds of thousands of dollars in expenses,
Mm-hmm.
and you'd hate to have to pay for that personally because you missed your enrollment period.
Oh, that'd be unfortunate.
Yes, it would be horribly. So let's not think about that. Let's actually just 3 months before we turn 65, make sure that you start talking to somebody about it. And it's incredibly important. It's going to be different for everybody now. All government programs change just about every year. So they make different changes. If you have any questions, feel free to call us. We are working on, in fact, I've got two people I'm going to be talking to in the next couple of weeks. We're looking for people who specialize in these types of insurances that we feel like we would be comfortable referring people to. So if you deal in this, feel free to give us a call. I'll be glad to talk to you about it, because we will be. It's not something that I think we want to do, but we do want to speak intelligently about it, and we would like to have somebody to be able to refer people out to. Like I said, I'm already interviewing two people, and we'll be interviewing others, so that I'll be collecting cards. People I think are going to do a good job. Oops, sorry about that. It's a big deal. Medical costs are the number one cost in retirement.
Mm-hmm.
That's what retirees spend the most money on,
Yeah.
is going to the doctor, medications.
It happens. Yep.
Yep. So, in fact, if you come to some of our workshops, you learn some of the meditation techniques. You'll need less medicine. You could actually avoid having to take a lot of medicines, especially hypertension, stuff for heart disease. It just really works. And investing is it's a highly emotional experience for an awful lot of people.
Yeah, it sure can be, but you, like you said, you can learn to control some of those emotions and
Absolutely. The more you do, the better you'll do it.
Yep. Practice.
And, the more knowledge you have, the more the easier it is to take. Knowledge in practice leads to experience. Experience is a great teacher. I would much prefer if it were somebody else's experience that I could learn from. Some things you just can't. I mean, some things you literally have to experience. Yep. But if you're getting good information, good quality information, and you're being coached, you and I were talking about this before the show today. I had these coaches when I was little, and it was mental preparation.
Oh yeah,
that's what it was.
Yep. And
they were coaching us up, and it was highly effective. Got a bunch of little kids to do things that a lot of grown men can't do. And I know people think that I'm full of it when I say that. No, you didn't know my team, and you didn't know these guys either. And but it's mental. It's 95% mental. Whether or not I think life.
Oh yeah, it's about your mindset's more than half the battle for sure.
Might be closer to 98 or 99. Yeah. 2% actual experience and 98% your interpretation and your reactions to the experiences.
Yep.
So, and that's one of the things that I know it doesn't have much. People don't think it has a lot to do with investing. Investing is not black and white. Peter Lynch, I keep referring back to his books over and over and over again. I thank God I was able to get them on Kindle because I kept giving my paperback copies away, and I probably spent $1,000 at least. And I think the book's only $15.
Yeah,
I've given at least $1,000 worth of those books away, and very practical. And he talked about the mental aspects of investing, and how he didn't go on and expound upon it the way that I am. But he did say some things I thought that were very telling. He said it has more to do with your gut, your willingness to stick in with volatility. That was more important as an investor than how smart you were or how well you even knew financial statements.
Yeah.
And by the way, he was a liberal arts major.
Interesting.
He didn't major in finance.
Interesting. Yeah, he's an interesting guy.
Yeah.
He is.
He is. And that guy still works hard.
Yeah.
I mean, really hard. And it's just amazing how productive some people can actually be in their lives. Yep. So, and he wrote pretty simply, and he was fond of asking his wife what she thought of certain products, and his girls who are still working with them.
They're all a good team, yeah.
Yep. And so he would go out and find these companies that looked good on paper. The financial statements looked like they had pretty decent growth. And then he'd go ask his wife, what do you think of legs? And he brought that one up in particular. What do you think of these things? And they would go out and try products, and just to get kind of a better feel for what the company actually made, not just the financial statement. And I thought that was really interesting, very inspiring. And it became very clear to me that you cannot judge a book by its cover, because he looks like Andy Warhol.
Yeah.
If you look at him today, he always has actually. And his hair went white really early.
Yeah, it did. Yeah.
And it's kind of funny. You would never think that he's as strong emotionally as he was. Yeah. That guy was fearless. He was it looked like a teddy bear, and he had a tiger inside. And so not judging books by the cover. And he was very, he even talked about women in investing because they bought a lot of the products. Said they observed the same things that in my career that I've been able to observe. I guess just about anybody that came up during that era would probably have observed the same sort of things. And I've met a lot of women who were older, have called me through the radio over the years and have asked about certain things, and I was really surprised that they were very astute, and it was a pleasant surprise. Actually, it makes my job a lot easier.
Yeah, that's great.
The smarter you are, the less hard I have to work. So anyway, that word overcomplicated just sticks out in my mind from our conversation earlier, and I see it all the time. Yeah. Investing really can be simple. It's probably never going to be really easy because S&P 500's average range is 29%.
Yeah, sure.
That makes it complicated. Not complicated. It makes it challenging.
Yeah,
You know,
that's a
it's
good word. Yep. Mm-hmm.
And because when it's at the bottom of that 29% range, and then it has another 29% jump, everybody's going, wow, you know, maybe this is really the big one. And you just have to remember, go back and look at all the history.
Right.
One of the reasons we did that ebook on the dividend model was so that you could see the declines as well as the increases, the good, the bad, and the ugly.
Yeah,
you get to see it all.
It was super insightful. I really like that.
Oh, that's good. That's good. Because I liked it. I used to see that firsthand when I worked at Fidelity. I got to see the holdings. They had these special books that they would put out for the reps that were out in the field. There were only 170 of us at the time across the entire country.
Wow.
Only 170 people that did that.
Not that many.
No, especially for a firm that size.
Right.
They had a lot of telephone reps.
Oh, okay.
We were the ones in the field that would actually meet with clients if they wanted to come into the office.
Gotcha. Okay.
And so that's basically how that worked. And we got more information, more insight, and I got to see what they were buying, what they were selling. And it was really fascinating. And to see that you'd watch the volatility of the stocks in the portfolios and like, whoa. And then you see the net result of the total fund. The net asset value is the collective value of all those individual values. Okay, and you look at that, you're like, hey, wait a minute, that barely moved. It's like, hey, how does that work? And then you see, oh yeah, because this stock went up a lot, and your mind has a tendency to go to the ones that go down.
Sure.
A lot. And by the way, this is something that I've observed in the field is that somebody's eye has a tendency to either go to the one that's dropped significantly or go to those that are up significantly. And it really depends on their perception.
Sure, yeah.
Of the, So, hey, I hear the music. You've been listening to Melissa Arcari and Bill Bullington this hour. We're on every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.